Okay, yes, it's me again. Now, the last time we spoke about the coronavirus on my YouTube channel, the numbers were looking vastly different. Fair to say now, this coronavirus, the COVID-19, is spreading across the globe at an unprecedented level. Numbers are not looking particularly good either. At the moment, the time of recording, we're seeing confirmed cases 550,000. Chances are this number is going to be dwarfed by reality. Most people aren't getting tested and even diagnosed. So this could be 10, 20, 30, 40, 50 times out of reality. At the moment, we are seeing total casualties of almost 25,000 across the globe. Biggest areas of concern: Italy, 8,200, Spain, 4,800. Hubei province now in third position with 3,100. Iran below, and then France below there as well. Only positives, I guess, to take out of this at the moment is that we are seeing an increase in the number of people that have recovered from the coronavirus. It still is a mild disease for many. To hear the acceleration of this graph here as well, showing you how it's basically taken off now and pointing almost in a 45-degree angle. This is a great information site courtesy of the Johns Hopkins University Medicine. Basically allows you to track the coronavirus as it evolves in your particular area as well. You can zoom into your area and see exactly what is going on, and it pulls up the data as well. A great site as well that you should be looking at if you want to keep a track of it for whatever you need that information for. Now, today I want to speak specifically about the impact that the coronavirus is having on the financial markets. We're all seeing all this news about stimulus and so forth. So today we're going to do some jargon busting. We're going to basically try and make sense of it all, and also maybe show you how I think you should be positioning yourself in the financial markets in this current climate. So we're going to talk about making sense of the financial markets with the coronavirus. Okay, so before we get into the nuts and bolts, let me remind you to subscribe to the channel if you don't already do so. Make sure you hit that bell notification. That way you'll be notified the moment the next video has been released. And I will be upping the content in the coming weeks and months as well, much more regular as well. So it's well worth doing that. Don't forget to follow us on Instagram and Twitter, and of course Facebook. If you follow us on Facebook, you can tune in live every Monday afternoon, 2 p.m. London time, where we stream live to everyone that wants to come in, discussing trading opportunities for the week ahead. I look forward to seeing you in there. You can discuss with me and chat with me real time as well. So first up, what is a bear market? As you no doubt have seen, the stock markets around the world have been in global meltdown. A bear market is defined as when the stock market, from the recent high to where it falls to, exceeds 20%. 20% reduction in share prices constitutes a bear market. Now, in the last, say, 5 decades, there's actually been 7 bear markets. For those that know me, I've been trading for around 30 years. I've actually experienced 5 bear markets. I've traded through 5 bear markets. Let me show you exactly what's going on in the markets at the moment. This is a screenshot of the S&P 500, the top 500 companies traded in America. So you see we've dropped from 3,000, almost 400, down to 2,186. This has been a 64% reduction in the stocks in the S&P 500. That is a bear market. The Dow, which is the top 30 companies traded in the US, that's seen a drop from 29,600 in the middle of February, about Valentine's Day, to a low of 18,200. That's a 62% drop. This is the DAX. This is the German index. It's fallen from 13,800 to a low of 7,900 plus, and that is a drop of 57%. If you're holding pension pots, if you're holding 401 accounts, looking forward to your retirement, potentially you've seen a huge drop in the holdings and the value of that. People are panicking out of the stock market. This is a classic case of a bear market. Here is the FTSE 100. The UK has not escaped the panic. dropped from 7,700 pretty much, 62% drop down to 4,700. We're having a bit of a bounce at the moment. We're going to talk a bit more about that later on in the video. But a 62% drop in the FTSE, and of course the Nikkei 225, that hasn't escaped either. A 65% drop of those Asian shares from 24,000 down to 15,000. And get this, this is the Hang Seng. This is the Hong Kong top 50 stocks. That's seen a reduction of 72%. There is mass panic, a mass exodus of stocks from people that are now fearing about their investments going down even further. So what has been the response, the policy response from the governments, the central banks, and of course the companies to deal with this global epidemic, the global panic that we're seeing in the financial markets? Now, it started off with the central banks slashing interest rates across the globe. I think it was Australia that started now just about 3 short weeks ago. They cut their interest rates in order to deal with this big financial problem that we're seeing in the markets. Then the Fed, that's the US central bank, they cut their rates unexpected midweek in between meetings to an unprecedented level as well. They followed that up a couple of days later with a cut on the weekend. On a Sunday, they cut their interest rates now pretty much down to zero, and all the other central banks have followed. The UK have followed, Bank of Canada have followed, Bank of New Zealand have followed. All the main central banks now are slashing interest rates. Why are they doing this? Well, basically they want to make money available to everyone in order to basically weather this massive storm that we are currently in. They want to be able to lend money to banks at low interest rates so the banks can lend to companies to basically ease the big problem that we are in. So making cheap money available is one way that the governments or the central banks are trying to stem off this massive downflow that you're seeing. And then you've got the governments adding stimulus. Now the governments do this by the means of what's known as quantitative easing. You may have heard that expression before. It's basically when the governments start to buy government bonds, the bonds that they've lent out in the past in order to raise money, they're buying them back from the market. And when they buy them back from the market, they're basically putting money, cash, into the market, into the economy, to allow the economy to weather this storm. Just announced this week, the US government have agreed a $2 trillion stimulus program to put that money back into companies, to fund banks and local institutions to make sure that they can weather this massive problem that we've got. Adding stimulus is basically a method that's been adopted now by all the main governments around. UK, Europe are all taking part in this massive stimulus program. Also, governments are now paying people's wages. They're basically saying don't go to work. Don't go to work, but the governments will pay your salary up to a certain maximum amount, of course. That's certainly happening here in the UK. It's happening out in the States as well. Basically encouraging members of the public not to go to the workplace, and they will pick up the tab. I think the US just announced they're going to do a parachute, $1,500 to every US citizen. You better check the details about that. It's just something I picked up on the wires earlier. Companies are freezing the buybacks of their stock. Normally when a company does well, one of the things it does with its revenue is to buy back some of its own stock, thus supporting the share price. A lot of the companies now are freezing the buyback of their own stock. Again, that doesn't help the stock price itself. It actually leads to a push lower in stock prices, as there's no support there coming from within. So these are the main things that are really happening in the economy at the moment. The central banks and the governments are desperately trying to support the economy. We know when you have these bear markets that we're seeing at the moment often lead to recession. A recession is known as when an economy has two quarterly periods of negative growth. The first batch of data came out just yesterday, basically telling you how many people had joined the claimant count in the US. Normally last month, that number was around 270,000. This month's read came in at 3.6 million. 3.6 million people in the US have now filed for unemployment benefit. A massive, unprecedented amount. And that number is likely to only get worse. Next week, we're going to be looking at the non-farm payroll. typically non-farm payroll, we look at the rate being, unemployment rate being maybe 3.8%. If it comes in at 3.7%, the markets are buying the dollar because they think that's great. If it comes in at maybe 4%, the markets were looking to sell the dollar, as that's not good for the economy. Next week's non-farm payroll could be up at 30% unemployment. Mnuchin, the Treasury Secretary, is hinting that the numbers are going to be massively to the upside. So we do need to watch this type of data. So how do we trade this mass panic that's ripping through the financial markets? Well, of course, that depends on your personal objectives. What are your financial objectives? How old are you? What do you want to achieve out of the market? Chances are if you're in your 20s, 30s and 40s and 50s, this is most probably a good time to buy the stock market. A lot of the stocks, the good quality companies, they've been pulled down by the mass selling across major indices. Some of these companies are still solidly good companies. This is not investment advice. Disclaimer, disclaimer. Please go and seek professional advice elsewhere before you invest in the markets. Here's an interesting chart that I want to share with you. I put together last night. Now, it basically outlines the last 5 bear markets that we've seen in the last, say, 30 years, certainly since I have been trading the markets. Most of you haven't, as I say, traded the financial markets through a bear market before. Here, back in 1973, the red depicts the percentage drop in the S&P 500 over a period of time. So you see here in 1973, the S&P 500 was down 45%. Okay, and that bear market lasted for 21 months. And interesting enough here, it took 69 months to get back to where it was before the crash happened. That was basically caused by the collapse of the Bretton Woods and then the Nixon scandal and so forth. August 87, this was my first bear market that I was involved in. August 1987, this saw, it's known as Black Wednesday. The markets basically took reaction to what they thought to be a computer generated sell, which led to mass selling across all stocks, and then of course the dollar came under pressure and it was absolutely chaotic. The stock market that day or that period dropped 34%. Took 4 months for this period of bear market conditions. I mean, interestingly enough, it only took 20 months, just about a year and a half, to get back to where it was before the crash happened. Then, of course, we had March 2000. The markets collapsed 50% in the March of 2000. And, of course, that lasted 31 months before it finally recovered. And it took 56 months to get back to where it was before the crash happened. Interestingly enough, all the markets have recovered over a period of time. It's just a matter of when and how long it takes. A lot of you will remember the financial crash in 2000, the global financial crisis. Major investment banks around the world were collapsing. Lehman Brothers, for one. I in fact worked for Lehman Brothers for a period of time, well before the crash, and I had nothing to do with it. But the financial crisis saw the stock market, the S&P 500, drop 56%. Other indices were down more, but we're looking at the S&P, 56%. The world had basically come to a standstill. Incidentally, it took 49 months to get back to where the pre-crash was. It got back certainly higher now. In the last couple of months or so, we've been at record highs. Now, this crash, 2020, March 2020, it's still in its evolution. We've dropped 62%. At the moment, we are just in 1 month of it. We don't know at this moment in time what this candle is going to show. But at some point, no doubt, it will be a recovery. We just don't know how long that recovery will work. So depending on what your financial objectives are, if you're looking to put money away into a pension pot, then most possibly this is a good time to be averaging in as more declines happen, knowing that at some point in the future, maybe 5 years time, we don't know, but the markets will be higher than where they are at the moment. After all, it's happened for the last 7, indeed, financial bear markets that we have seen. Remember, this is not financial investment advice. Go and seek financial advice from your qualified financial advisor. So that's basically where we are at the moment. All depends on your own personal circumstances. I do hear the argument that this bear market is different, not only in the scale and the speed of the decline, but the reasons behind it. After all, this is a supply-driven downturn, which basically often leads to these sharp downturns in production. Companies don't want to produce because there's no demand, because people aren't working. And that is indeed likely to continue, possibly far longer than we have seen in the past. But I'm confident that we will get there at some point. Now that's obviously if you're investing in the long term in the stock market. Trading the stocks on a daily time frame basically is quite a treacherous time at the moment. We're seeing still big swings, and you saw on the chart I showed you a moment ago here the Dow seen this big 62% drop, but now we're having a pullback in the Dow. In fact, over the last couple of days the Dow has gone into a bull market. Basically we've bounced 20% from these lows. But as I say, trading the stock market on a daily basis can be quite indeed treacherous. So of course these massive moves we're seeing in the stock market, these have ripple effects, knock-on effects on other asset classes, in particular the forex market. Now we've had a right good run in the last 3 or 4 weeks in the trading room here at forexsignals.com because the markets have had some really good trends that haven't really had a significant pullback. And of course, if you're following my trend following strategies that you teach in the room, you will know all about that. There's been a big flow of money going into the safety of the US dollar. And of course, the weaker currencies that have been selling off against that, the euro and so forth, the Australian dollar, New Zealand dollar, Canadian dollar, have all been played to the downside. Wonderful trends. We've had a great run. If you want to learn more about the trend following strategy, do come over to the room here at forexsignals.com. You can sign up, take a 7-day free trial. It won't cost you a dime if you don't want to stay. Now, do leave me a comment if you like this video. Give me a thumbs up, give me a thumbs down. Don't forget to follow us now on Instagram and Twitter. And of course, if you follow us on Facebook, you can tune in to that live event every Monday. It's 2 p.m. London time. We'll give a bit of a snippet, bit of a clue to what we're thinking for the week ahead. Let me just leave you with this screenshot. If you are investing in the stock market, okay, this is a wonderful chart. It shows you that all the bear markets that we've had in the past, at some point, at some time, we will recover and make new highs. It's just a matter of when. Think about it. It's the people that are selling down here and here, here and here that ultimately are the losers. I'll leave that one with you.